My name is Steve Lockshin. I'm the founder of Vanilla. I've been a wealth advisor for over 30 years. I started Vanilla to solve a problem that we had as advisors, which was focusing on estate planning over investment planning. I think the first conversations you have with a client set the tone for the entire relationship. There has to be a level of trust where the client's willing to disclose things that are really important to them. It's about as intimate a relationship as you can get. You find out about their health, who they love, their relationship with money, what their net worth is. So that first meeting is really important. Today we're going to walk through a checklist of questions and first conversations with the client to help lead into these important discussions. We'll walk through questions that I would ask in a first meeting with a client, but know that each of these questions may take a little tributary based on the answers that you receive. So think of this as a guide. And in fact, at the end, you will get a guide, a checklist, in fact, that you can use with your clients. I think the easiest way to begin the conversation is at a very high level. So at 50,000 feet, what's their net worth? Who do they love? What do they want to take care of? And then we go from there. Dropping down from that 50,000 foot level, there are things that will help guide the discussion. Are there extenuating circumstances? Are there special needs children, parents? Are there divorces we need to think about? Prenuptial agreements? Anything that would cause us to ask questions that we might otherwise avoid in more typical circumstances. The next question I might ask is, what is the role that money plays in your family? And lots of different answers come out of that, and it's best to probably let the client freewheel with what comes to their mind. So in some cases, they may want to leave as much as they can to their children because they had nothing when they grew up. Or the opposite may very well be true, where they don't want to create trust fund babies. These are the discussions that we often have with clients, and making sure that we get a chance to hear what's important to them so we can help redirect or identify things that may not have worked in other circumstances so they can think about them. That drives a lot of the conversation. To be honest, as we have these conversations with clients about their relationship with money, it's difficult at times not to inject your philosophy around money. I mean, having spent decades meeting families of wealth and seeing what weaponizing wealth can do to families, I have a very strong opinion about them. But it is important when a client has a opinion that is different than mine, that I listen to that and help guide them and to meet their objectives. However, I do want to make sure that we ask the right questions so they think about things they may not have thought of. Remember, we've seen this over and over and over, and they're probably doing it for the first or second or third time. For a client who's still accumulating wealth, there are really only a couple things that we care about. Those all are related to family security. I want to make sure that the survivors have enough assets to maintain their lifestyle in whatever manner is appropriate, and that the documents are in place to ensure that their wishes are carried out in a manner that is consistent with their belief system. When talking about how much money somebody needs to meet their lifestyle, most people don't know what they spend. So a subtraction method typically works for me, which is, how much do you earn? What do you pay in taxes? And are you a net saver or a net spender? From that, you can pretty quickly figure out what their annual burn is. Finding out about school for their children, if that matters. Or do they want private school as part of the equation? And do they want their surviving partner to have to go back to work or not? Are all important things that will be part of the calculus in determining what their cash flow needs are. From there, it's a simple math equation where you take their total net worth, you subtract from that any liabilities that they have, you add to it any assets they have, and then you multiply it times 33. And that should tell you how much money they need in savings in order to meet their objectives, the difference of which can be made up with life insurance. So where does the 33 times your spending come from? It's basically Monte Carlo simulation. If you look at a typical diversified portfolio, let's say it's supposed to average about 7%. Figure 3% for inflation, 1% for volatility, and 3% to spend. Well, there's your 7%. And a little bit of factors in there for some years are positive, some years are negative. It obviously isn't a consistent line. But when you look at it, you can spend about 3% and not run out of money adjusted for inflation and taxes, and that's where 33 times comes from. There are two primary considerations around life insurance. One is whether you buy term or permanent life insurance, and without spending too much time talking about the differences, I'd say if you're a great saver, then term is probably going to be fine. If you're not going to need insurance more than 10 years from now, the term is probably going to be fine. If you're not such a great saver and you're going to need insurance for more than 10 years, then a form of permanent, and there's lots of different types of permanent insurance that will go beyond the scope of this discussion. The other thing to consider is whether or not that insurance benefit will throw your family into a taxable estate situation. And if it does, having the insurance owned in a life insurance trust can keep those assets from dramatically and instantly raising the value of the estate and creating an unnecessary tax complication. Insurance is typically purchased for one of two reasons: either to create an estate in the event you don't have enough wealth to protect the ones you care about, or if you have so much wealth but you're not liquid, to create liquidity to basically purchase assets from the estate and create liquidity for the estate using the insurance proceeds to pay estate taxes. Those are the two times that people look at insurance. When talking about clients with significant wealth, I actually probably would break that into a couple different categories. There's certainly wealth above the estate tax exemption limit, which is real wealth, but then there is exceptional wealth that is well beyond what a family could ever reasonably spend during their lifetime. And then there's everything in between. And there's different questions depending on which set of circumstances they're in. But one of the questions I always ask is, what is this for? What do you want to happen at the end of the rainbow? For a lot of people, you get interesting answers, particularly those with exceptional wealth. One of my favorite lines is from a client who says, "I'm running a race with no end." It's all about the game. It's about accumulating wealth and being productive and being an entrepreneur. It's not about maximizing their wealth. That's just a way to measure. So for them, it's about feeling good because they've created and continue to create something. It keeps your mind sharp. For the merely wealthy, if you will, those who are over the estate tax exemption limit, it's about maintaining their lifestyle. And I'd say for folks, that's their number one thing is, I don't want to change my lifestyle for anybody. Everybody's always willing to upgrade it, but nobody wants to go backward. When considering how to structure wealth for a family, trusts play an important role, and that comes into play when we talk about creditors, divorce, things that could eat away at that wealth. So for example, if I've created a significant amount of wealth and I distribute it immediately to one of my children, I die and it gets split up by the number of children I have, and that child gets married and turns that into community property and they get divorced, half of it's gone. Or they get in a car accident and or slip and fall at the house and they're sued, everything in their estate is subject to that liability. But assets held in an irrevocable trust that are properly structured will protect those assets from divorce and creditors. A typical estate plan that I come across is per stirpital planning. I'd say 99% of attorneys divide assets by the number of children that someone has. The challenge with that type of structure is that it really doesn't think beyond the next generation. So I may think, I know my 3 children, they're all adults, and the fair thing is to divide it equally, which is fair. However, what if one child has 10 children, one child has 1 child, and one has 5? Now my grandchildren are treated in a very different they have very different economic outcomes. And if I love my grandchildren equally, which hopefully I will, I'd want them all to be treated the same. So deciding whether to just divide things up, which is traditional planning, or create what we call a family bank that treats every heir the same is a big discussion that I have with a lot of clients. I'm not necessarily talking about a pot trust per se, although it may start as a pot trust. It may be a number of trusts that are all considered together. It may be per capita, but very often when I introduce the idea to families of would you like to give a specific amount to each child at various ages, all adjusted for inflation since they're not all getting it at the same time? Or do you want to help them with housing or school? Those are the things that start to touch on the values that are important to that person, as opposed to the traditional, I've got a bunch of money and I'm just going to divide it up by the number of heirs that I have. In some traditional planning, you'll see lump sum distributions, and very often it's because the settlor wants to basically bestow something upon one of their heirs. Thinking, wow, it would have been great if I inherited $1 million or whatever the number is when my parents passed away. But when you think about the meaning of wealth, and we talked about it earlier, the goal is to be able to have a consistent stream of income so that you can meet your life's obligations. And as we often see with people who won the lottery, if you get too much too soon, there's high risk that you run through it. There's also high risk of liability that we talked about. So I generally talk to clients about the understanding that they can meter the money out in whatever form they want. It doesn't have to come in a lump sum or the very traditional route of a third when they're 35, a third when they're 45, and a third when they're 55. Those are kind of old school ways of setting up an estate plan and not ones that I typically advocate. An alternative to that structure is the family bank structure that I've mentioned, which is the consideration of all the trusts as one that is governed by, let's say, a letter of wishes, or it can even be inside the trust documents that suggest that the things that I care about as the settlor, the person who sets up the trust, are going to be met. I want all of my heirs to be able to go to school. So that's a first priority. I want some help with housing. And in the Warren Buffett words, enough to do something, but not so much to do nothing. So it can meter out a specific dollar amount at various ages. So in their 30s, they get X. In their 40s, they get 2X per year, adjusted for inflation. And in their 50s and beyond, they might get 4X. But never so much that they can just stop achieving, because I think that's one of the important things that a person can do for their happiness, which is achieve and feel good about themselves. Understanding a client's charitable goals is important because there's various types of charitable planning that can be considered both while they're alive and at their death, some of which can reduce the estate tax burden that a family may have. So understanding their charitable intent is key to developing the ideal plan for a family. From a philosophical standpoint, I'd say there's a multitude of ways that families think about charity. Some figure I've given enough during my lifetime, I'm not going to give anything when I'm gone. Some want to plan on continuing the giving that they gave during their life. Some want to use charitable planning as tax leverage. So for a lot of clients that have large taxable estates, if we've already accomplished getting enough out of their estate to support their heirs for the next 20 years, we might do a testamentary charitable lead trust, which basically takes everything else that's left in their estate when they die, sticks it in this trust. For 20 years, it pays out to charity. Whatever's left over can go to the next generation without any taxes. So there's lots of different philosophies. It really just depends on the circumstances and how the family thinks about charity. Some simple questions that should be asked at every estate planning review is, how old are your documents? And just because they're older or not as old as the typical 5-year number that's used, doesn't mean they're great documents or doesn't mean they're garbage documents. It just means if they're older than 5 years, they probably should be reviewed. Even if they're younger than 5 years, it's probably worth a review to see if they were well crafted. And then obviously making sure you've got the right documents, the right fiduciaries are all part of that review. Understanding if a document's well crafted is somewhat objective. However, there are red flags that can come up. So things like mandatory distributions automatically make those assets subject to creditors. And so those are things that are bozo no-nos for us when you can do things like put a dual invasion standard in there. There are other key things that practitioners care about that, let's just say, a quickly or poorly crafted document may not include. And so I think having competent counsel review your documents is always important. No less than annually, you should inquire with your clients whether or not there have been life changes. Have there been any births, deaths, change in financial circumstances, special needs that have come up, an accident, things of that nature, parents who need caring that may not have needed caring the year before. So understanding all of those things can help influence what your documents should read and making sure that you've got the proper vehicles within those documents to accomplish those goals. In most states, a standard will may suffice, but we typically recommend clients have revocable trust to go along with those wills. Typically, it's a pour-over will that says, anything that I have not properly titled in the name of my revocable trust should now be titled in the name of my revocable trust upon my passing. What the revocable trust does is answer questions like, who are the guardians for my children if I'm not here? Or what dispositive provisions do I want as opposed to what the state has laid out for kids? Or more importantly, avoiding probate, because it's a public, costly, and timely expense. So what I always tell people when they balk at the cost of doing documents now is you can pay this now, or your survivor can probably pay 10x that and have 10x the pain of dealing with it if an estate is not properly structured. Then on top of that, you need healthcare proxies, financial proxies, a living will, if you will, and then documents for your adult children that have not planned for themselves yet. Normally, the wealth of the client will dictate whether or not you need irrevocable trust, as they're generally tools for doing planning to get assets out of your estate. However, if there's a special needs trust, or you know that a parent may have dementia and you want to reduce their assets and get them to plan so that they can benefit from state-funded care, and that may be true of a child or a sibling. Those are times when an irrevocable trust may make sense. I talked about having an irrevocable life insurance trust so you don't overpopulate your estate with insurance proceeds and now create taxes where there weren't taxes before. So depending on the circumstances, irrevocable trusts are important vehicles. But if you have a taxable estate, you almost certainly should have an irrevocable trust. One of the most entertaining things when reviewing a client's estate planning documents is asking them who their current fiduciaries are, because more often than not, they can't remember or they get some of them wrong. When you review the list of fiduciaries with them, too often they're not talking to that person anymore, or somebody died, or they want to change. And when picking these fiduciaries, I always encourage people to select someone who is intelligent about estate planning, knows where to find valued professionals, and not somebody who just knows their kids, because this, fortunately or unfortunately, is very much driven by the law and process, and you want folks that know how to shepherd your survivors through that process. Asking somebody to be your executor or to be a trustee, when I'm asked about that from a client, I'll usually say, do they not like you? Because it's a horrible job, typically with no pay. And with it comes risks, being a trustee. So in today's environment, you actually have unlimited risk as a trustee. If you even foot fault around the assets, the beneficiaries can sue you. So thinking through whether or not you want to be a fiduciary, I always recommend start with your lawyer, start with your accountant, start with somebody that is a professional and probably has insurance and has dealt with this before. Those are the right people. They can consult with people that know your family, but pick professionals. That's my advice. When getting a client started on their estate planning documents or process, I'll usually tell them they just need to think about a couple things. First and foremost, who do they want to be a guardian of any minor children if they have minor children? And a backup. And everything I mentioned, there should be a successor or a backup for. So assume you need to think of 2 people for each role. Who do you want to make healthcare decisions for you if you're unable to make decisions for yourself? Who do you want to make financial decisions for you if you're unable to make those for yourself? And then there are some decisions you don't want to give to other people, like your living will. And so if you want to have all means exhausted to keep you alive, then you can put that in your living will. Or if you're like me and you're ready to have them pull the plug when you've got a hangnail, that's fine too. But those documents help lay out the foundation for that. And then the hardest but most useless question that gets asked is takers of last resort, which is when all of your heirs that are named in your document are no longer alive. So there's a catastrophic event. Who would you like to receive the assets, and people get hung up on two things always. First is the takers of last resort, which is silly because it almost never happens. And I honestly just recommend picking some charities or classes of charities that matter to you. And the second is who's going to take care of the kids. And so often parents wait and wait because there's an argument about whose parents are going to take over the kids. And my answer is very simple. Don't worry about it. The state has a plan for you if you don't get something done. They'll send your kids where they want to. Or you can put it in your document and have exactly what you want to happen. So don't let perfect get in the way of good. The most overlooked topic in estate planning that I typically deal with is adult children that are not married or haven't otherwise planned for themselves. So think your child going off to college. All parents should have a HIPAA release, a healthcare proxy, and financial proxies in the event something happens to their child, a car accident, a sports injury, whatever it may be, and they can then manage their finances. If they need to deal with the hospital, technically if they're age of majority, the hospital doesn't need to tell them anything, hence the HIPAA release. So simple, easy documents, super light, something that's really important, and often colleges will make those available if you need, or you can get them online. By now we've touched on most of the basics and important discussions you'll have when you talk to a client about their estate planning the first time. Just remember that no matter how you get paid or what you focus on, this is a fundamental part of your client's family security and your relationship with that client. And it isn't just what you do today, it's what you do every year that solidifies that relationship and makes sure that their family's cared for. Because when push comes to shove, the surviving spouse cares about one thing: am I going to be okay? And these are the things that help ensure that you can answer yes to that question.